It's that time of the year when we are excited to present the highly anticipated economic overview brought to you by BBH. This review is a cornerstone of Sintercafé, offering valuable insights and analysis of the coffee market's economic landscape. This year we have Mr. Faustino Cortina, Managing Director and Relationship Manager at BBH's Multi-Family Office. Let's welcome him with a warm round of applause. Thank you.
Thank you. Great, thank you. Great, thank you. I'm very excited to be here with you today. It's my first time at Sintercafé. But Brown Brothers Harriman has been participating for the last 12 years or so we've been part of the tradition. For me, it's been a nice experience because I got to meet a lot of business owners and executives, and everybody's been very kind and very welcoming. So thank you for my, that warm welcome. I'm going to be talking about the U.S. economy, but at the same time, I have a little surprise for you. I'm also going to talk a little bit about you, because we're going to go through a little journey, and we'll get to that. But before I go into the presentation, I wanted to introduce myself. I'm Faustino Cortina, as mentioned, a managing director at Brown Brothers Harriman. For those who don't know Brown Brothers Harriman, we also go by Brown Brothers or BBH. We are the oldest private financial institution in the United States. We were founded in 1818, so over 200 years old. So we have this very deep tradition. The other tradition is in coffee. Our first financing that we did in coffee was actually in 1857, and we've continued to be involved with coffee ever since. And thankfully, and thanks in large part to some of the clients that are here in this room. So we want to thank you for that partnership. So that's a little bit about Brown Brothers. So I mentioned that this is my first time at Sintercafé, but it's not my first time to Costa Rica. My first time to Costa Rica was 30 years ago, and I did the Pura Vida route, right? I went to the rainforest, that's me, in that little tiny, at the bottom. I even went in the water. Anybody notice anything different? I had so much hair. I'm so jealous of my former self. I don't know if is it okay to be envious of your younger self? Because I am very jealous of my younger self, so I might need therapy after this presentation. So then I try to climb a tree, and not any tree. I try to climb a coconut tree, of course, to get a coconut. And I was doing it to try to impress, of course, you try to impress a girl. I never got the coconut, but I ended up getting married with my wife, Alma, from Mexico. And we had a family with 2 kids, Faustino Jr. and Paulina, right? So that's me during the last 30 years. And now you're asking, Faustino, why are we talking about your last 30 years and that you lost your hair and that you had a family? Well, one of the things that the sponsors of Sintercafé asked, they said, could you please talk about the U.S. economy, but do me a favor, talk a little bit about the audience, talk about you and your countries. So we're going to do a little journey together. We're going to look at what happened to you the last 30 years. And we're going to look at your different countries, and hopefully you could identify your country up here, because I took it from the participations list. And we're going to see 4 economic metrics. We're going to look at literacy, we're going to look at poverty, we're going to look at population growth, and we're going to look at GDP per capita. And this is for you, what happened to you the last 20, 30 years. When we look at literacy rates, it's a little noisy, right? It's like, some countries reported better than others. So when you strip out the noise, you see that Latin America did pretty well. Like Latin America outpaced the world literacy rates the last 2 decades, and it went from 90 to 95. And we know that's important because the more literate, the more educated workforce, the more you climb up the value chain, right? You have a more knowledgeable workforce, educated. So we're off to a good start. You guys did a nice job on that front. Poverty. It's very noisy, so I'm going to strip out the noise again. And you see that world poverty rates have been coming down. But Latin America also did a better job. It went from around 12, 13% to around 4%. And we're going to be talking about GDP, and why we care about poverty, as you all know, is as the GDP continues to improve in a country, you want to make sure it helps all the levels, including the lower income class. And you guys have been doing a nice job of that as well. So that's poverty rates. Next, we're going to look at population. And to understand this, we're doing it normalized to 100. So we could compare over the last 30 years, what are the different relative growth rates, right? So we indexed to 100. The world went to about 150. So that means it had 50% growth rate. The population grew in the world 50% over the last 30 years. So just take a moment. Where do you think you land? Where do you think you land? Like, make a mental note. Were you above or below world? Were you one of the fast growers on population? Well, let's see. The United States was below. Not surprising, right? The demographics are below. The one that did surprise me was Brazil. Brazil actually had slower growth in the world. And it's funny because it was tracking the world, and then you had the financial crisis and Lava Jato, and then that diverted it from the growth that you were seeing in the world. So the next one is El Salvador. This is the lowest growth. But keep in mind, when we look at population of a country, it's not just, you have to take into account migration, right? So opportunities in a country, if they're less, so people decide to leave the country, and then that affects your productivity as well. So sadly, that's what happened to El Salvador. Because when I dug a little deeper on El Salvador, the birth rates were the same as the rest of Latin American countries. So it means that people are leaving the last 30 years El Salvador, and we'll see if that reverses with the new government. So that's looking at the slower growers. Who do you think the fast grower was? Honduras. Honduras saw almost a double in its population in the last 30 years, from 100 to 200, so a double fold, and then followed closely by Guatemala, Panama, and Ecuador. So those are the ones that I would consider more the faster growers on the population. So the rest are kind of a little bit more grouped together. You have Nicaragua, you have Costa Rica, you have Colombia, Dominican Republic, and Mexico. Those are all kind of clumped together. So when you put it all together, pretty wide disbursement on population growth, right? With El Salvador at the bottom and Honduras at the top. So were you surprised by your country? Did you do better? Did you do worse? It'd be interesting to see what you were thinking and what the numbers actually were over the last 30 years. So now we're going to look at GDP per capita. So again, we're looking at GDP. So I take the GDP, the PIB of a country, and I divide it by the population that we looked at. So that's looking at what's the GDP, the economy, divided per individual. Okay, make a mental note. Where do you think you're going to land? The United States, slightly above. Okay, not too surprising. It's going to be harder for them to have, since they have a bigger base. Europe lagged. And it's interesting, again, to see how it lagged. You see that it caught up around the financial crisis, 2008, and then it's never recovered versus the rest of the world. It started diverting. So Europe had lower GDP per capita growth. So this is, again, growth rates. We're comparing growth rates one against the other. Mexico. Mexico is interesting to me because anybody remember when NAFTA got started? 1994, right? So this is looking the last 30 years, and it's curious that there are people saying, does Mexico benefit, does it not? They end up at the exact same spot. 30 years later, after NAFTA, they end up with the same GDP per capita growth over that 30-year period. So that seems pretty interesting. And then you have Honduras slightly above. Okay, let's go back to who are your fast growers? Okay, mental check. Do you think you're one of the fast growers? The fast grower was the Dominican Republic. and meaningful, right? It goes from 100 to 700. So that means it's a 600% growth in GDP per capita in the Dominican Republic the last 30 years. Nicaragua, not far behind. And the Costa Ricans in the room are going to be happy with this one. Costa Rica's right there too. So really fast GDP per capita growth. Panama. And the one that surprises me again is Brazil. Because look at that. Brazil was such a fast grower. It was the outlier. And then you had the financial crisis. You had Lava Jato, their economic crisis, political crisis. It completely starts lagging. And then now it's kind of bouncing. But that blue line, Brazil, is very volatile, right? So I thought that was very interesting. So when you put it all together, pretty diverse. You know, Dominican Republic, the winner. And then you see El Salvador toward the bottom along with the United States. So that's looking at growth rates, right? That's looking at, I'm comparing my GDP versus the growth rate versus other countries. But we know that GDPs are different sizes, right? So now let's look at it on absolute terms. What your actual GDP was in 1993 and what your GDP was in 2023, 30 years later. So here, it's a little bit distorted because I'm including the United States and Europe, right? The United States goes all the way to 80,000, so it throws off the scaling. But when we look at Latin America, you see the blue again, reminder, the blue is GDP in 1993, and the red is GDP in 2023, 30 years later. And the big winner is Panama, followed closely by Costa Rica, right? The GDP per capita is pretty significant. And then Mexico had a higher base, but it kind of jumps up. And you see that pretty much everybody's a winner in a way because you see the blue lines significantly below the red lines. So this is just looking at GDP per capita on a relative basis. I had my own conclusion. I told you 30 years ago, I did a trip to Costa Rica. What I didn't tell you is that I flew through Panama, and I ended up in Mexico. So the three fastest growing countries are the ones I visited. So if you want fast growth in your country, you got to invite me. And then you'll have fast growth in the next 30 years. Okay, so that's like, I'm hopefully Noelia's happy with that because she wanted me to make sure we touch a little bit of your economies. And I hope you enjoy that 30-year journey with me. So now we'll go to the U.S. economy. So if you think about the U.S. economy, well, first, how many people know the saying, every dog has its day? There's a saying in the U.S., every dog has its day, which means at some point everybody's going to be lucky or they're going to be successful. This poor fellow never had his day. And many economists that were calling for a recession never had their day. Because if you had talked to an economist the last year or two, they would have all said, oh, recession. They would have said, is it a hard landing? Is it going to be a soft landing? You know, is it going to be short-lived recession? But they all expected some probability of a recession in 2023 or 2024. And what actually happened was that you saw pretty good growth. So this is 2023. This is on a quarterly basis. And you see each quarter, first quarter all the way to the second quarter. And then I didn't have time to input the third quarter 24, which is 2.8, another strong number. But you kind of see that we're not even close to being in a recession in any of these quarters. And what's interesting to see is the components. So we know GDP is comprised of personal consumption, business spending, government spending, and in the U.S., net exports, which usually is a negative number, right? We usually have a trade deficit. You could argue if that's a good signal, strength of the economy, or not being competitive, but regardless, you see the components of GDP. If there's one to consider to be important, it's the red one. The red one is personal consumption. And personal consumption in the United States is up to 70% of GDP, right? 70% of the economy is driven by the consumer. So if you remember one thing about the U.S. economy, it's the strength of the consumer is the engine of the economy, which is also important for many of you because if you have a strong consumer, they're buying that specialty coffee, they're going to Starbucks, they're going out, they're getting more of the premium products. So we're going to focus on that red bar. We're going to focus on the consumer and try to understand, is the consumer strong? Will the consumer continue to drive the economic growth? So what's the first thing one normally looks at when trying to analyze the consumer and the strength of the consumer? It's, do they have a job, right? The labor market. And when you look at the labor market, here you see the supply and demand. The red is the number of people, the supply, the workers. I want to go work, I'm your supply. And the job openings is the demand. I'm going to hire you, right? And historically, you always see the red above the blue, right? You see more people looking for work than job opportunities. Look what happened during COVID. You saw a reversal. And it was a pretty significant reversal where you see at one point, it was a 6 million person gap. And then it's dropped to around 3, and now it's 609,000. What does that mean? That means that there's 609 more jobs available than people looking for work. So there's this gap. And at some point, that's going to correct. And it's not going to be a tragedy, right? People are going to say, oh, no, it's going to cross, it's going to go back. It's going back to normal. But what does it mean for the consumer? If I have a job, and I know that if I lose my job, I could get a new job, I'm going to feel pretty comfortable. If the labor market gets a little bit tighter, I might change my behavior. But for now, the consumer is saying the job market's very, very strong. So that adds strength to the consumer, and that's exactly what we've seen. The other thing that people look very closely when analyzing the consumer is the household debt. Why? Anybody remember the global financial crisis, 2008? What was the reason that the economy, one of the drivers for the economy collapsing? The consumer was over-leveraged. They took out, they borrowed too much, bought a car they couldn't afford, they had a house they couldn't afford, they had a second home, and then when the economy turned a little bit south, that they were buried under debt. So when you look today, on the face of it, one would think, well, maybe we might be headed for trouble. Because in the last 5 years, you've had $4 trillion of new debt. And that's $4 trillion that gets spent, right? I borrow money, I spend it, it helps the economy. So from that standpoint, it's something that's significant. But it's kind of understanding what the numbers behind the debt are. The first thing that's important is mortgages is 12.5 of the 18 billion, right? So the big component is mortgages. And then you have that yellow part, which is home equity lines of credit tied to the home, the auto loans. Those are collateralized, right? So if you don't pay, you lose your home, you lose your car. So that's something that at least you have the collateral. The credit cards is something, keep in mind. Let's remember that. Remember credit cards red, right? Because we're going to look at a slide a little bit later to see what's happening with credit cards. But we've seen household debt increase, $4 trillion. But what's probably more important is, can you service the debt? Are you able to make your payments on the debt? And when you look at disposable income, for every $100 I have from my salary, from my income, I have to pay $9.80. I used to have to pay $13 during the financial crisis. And that $9.80, that 9.8% of my income, is actually pretty much in line with what we've seen the last 15 years. So there might be more debt, but the consumer is able to make their payments, and it's comfortable as far as a percentage of their income. Okay, so we're off to a good start. What's very interesting, this is probably one of my most interesting charts when looking at the debt. When you look at the total debt as a percentage of household assets, your wealth, it went from 24% to 12.3%. But I just told you that debt grew by $4 trillion. How can it be that household debt is actually almost less than about half of where we were during the financial crisis? Well, the underlying assets have moved up quite significantly, right? The value of people's homes have moved up. The stock market has moved up. people's 401ks, their savings, their retirement. So you've had the underlying assets move up. So that, if you're a consumer, and all of a sudden you have this wealth of assets, and your debt's a smaller percentage, you feel a little better, right? You feel like, I could go potentially spend a little more. Okay, this is, remember I told you to remember that red mark? So it's not all roses. This is the canary in the coal mine. Remember I told you to remember credit cards, red? Well, this is looking at delinquencies. This is looking at 90-day delinquencies. So I don't make my first payment, I don't make my second payment, I don't make my third payment. So 3 months in a row, I don't make my payment. And that usually is a signal of distress, right? And if I'm going to miss a payment, I'm not going to miss my mortgage, I'm not going to miss my auto loan, I'm going to miss my credit card. And you're starting to see that tick up the last 5 months. Not crazy, it's still kind of relatively close to historic. Some people argue it's normal because you're seeing higher interest rates, it's kind of baked in by the banks. You have the JP Morgan, Jamie Dimon saying that that's kind of normal trends, but it's something we would want to keep an eye on, right? We don't want that to creep into auto loans or mortgages, because as I said, the canary in the coal mine is credit cards. So let's look at household savings. Here it's very clear, the correlation, right? Disposable income goes up, you spend more. You almost see that correlation is so transparent. But what you don't spend is savings. And every year in the U.S., you have $1.9 trillion in savings. It's a big number. But we need to do it relative. Is it a big number? Is it a big number relative to personal income? And it's actually near a historic low, 4.8%. So Americans are not doing a good job of saving. They feel very comfortable, they feel that they have a job, and they don't necessarily think they have to be saving for a rainy day. So if you're not saving, that means you're spending. So at some point, there needs to be a little bit of a correction here. That's not sustainable. And that could change if, when I talked about the housing market, the labor market, if that starts correcting, people feel a little less comfortable, they might lose their job, it's harder to find a new job, they might say, maybe I should start saving, maybe I don't take that vacation. But right now, savings rates are historically low. So we can't talk about the consumer without talking about consumer prices or inflation, right? So this is looking at inflation. The blue is core inflation, and the reason why we like to look at the core inflation, strip out food and energy, is because that's what the central bank does. The Federal Reserve looks at core inflation. In middle of 2022, you saw inflation jump all the way to 9.1%. 9.1% is crazy in the United States, right? For a development country to have 9%, we haven't seen that for decades, not until the 70s. So that was the reason why the central bank had to hike up rates from 0 to 5.5%, which also is crazy in a matter of 15 months. But it seems to be working, right? You see that inflation has gradually been coming down and went to 2.4% in September. The October numbers that came out this week were 2.6, a little bit above. But you're seeing that the central bank is starting to feel a little bit more comfortable. Anybody know what the central bank target is? It's 2%. 2%, exactly. So you're getting close. But you see that it's been very sticky. That last part is always very sticky. I used to work a lot with emerging markets, and I always would, whenever I looked at inflation numbers and looking at monetary policy, it was always so difficult getting that last 2-3%. And especially that 1%. So it goes 2.4, 2.6, and we're going to see if they could get to that 2%. But it gets very difficult at that point. So that's looking at inflation. So here we did this exercise where we took inflation, we indexed it to 100, and then we saw how it evolved over the last 4 or 5 years. Why did we pick December 2019? That's right before COVID. So what happened to inflation since COVID? And you see, if I took a basket right before COVID of $100, it grew to $121.7, right? So now, a question. Do you think wages were higher or lower? We just had an election in which one of the issues was inflation, and people were worried about purchasing power, and they criticized the Democrats. And I'm not taking sides, I'm just saying it was an issue, that inflation was killing the consumer. Well, when you look at wages, and we do the same study, it actually was slightly above. So the purchasing power was restored, was kept, but what happens? You go to the store, and you buy that gallon of milk, and you feel it. I put gas in my car, and I feel it in my pocket. But then I get my pay raise at the end of the year, and I get my bonus, I deposit, and I don't necessarily feel it. But the reality is, when you look at earnings, hourly earnings, it's been in line, and that's positive for the consumer, right? You restore, you maintain your purchasing power. So that's looking at inflation versus wages. Okay, so we talked a bit about inflation. We said that it seems to be under control, and this is what the Federal Reserve is. So for those who don't know, the Fed fund rate, that is, in the United States, what is the proxy on the short-term side of the yield curve. That's the proxy for interest rates. That's what a lot of people then do spreads over, right? So that's like the barometer of interest rates. And what the Federal Reserve did when inflation, remember, inflation was at 9%, the Fed said, I'm going to hike rates to 5.25%, from 0 to 5.25%, and I'm going to try to put the brakes on inflation. And that's what they did. And the blue lines are what the Federal Reserve already did. That actually happened. They've raised rates, and recently in the last two central bank meetings, they gradually reduced rates for the first time after quite a while. They'd been hiking, maintain, and finally they're saying, we control inflation a little bit, let's bring it down. The market is the line in the red. That's not the Federal Reserve, that's what the market is pricing in. The market is pricing in that rates are going to be gradually coming down. And they've often been wrong, because that's been very, very volatile. Since this was prepared, the numbers are quite a bit higher with the Trump trade. So I can't talk about the U.S. economy without talking about politics. I don't know if everybody can read this. Don't talk to him, he's some crazy moderate, right? Because it seems that everywhere you go, not just the United States, everybody's far right or far left, and it's very hard to get anything in the middle, any decisions, anybody working together, and it's very extreme. I'm a moderate, so if anybody wants to talk to me at the cocktail, please talk to me. I'm very nice. So one of the issues which happens, if you're constantly fighting, so in the United States, the Republicans are saying, cut taxes, and then we want to less government, and the Democrats are saying we want to have higher taxes, and we want to spend money, and they're completely polar opposites. Where they do agree, and I'm not going to spend too much time on this because there's a lot of information, but on the far left chart, the part that matters is that box in the white, the borrowing. They both agree on deficit spending. You see the government spending on the left. You see the financing, which is they get taxes, Social Security, corporate taxes, and there's a shortfall. There's a fiscal deficit. And they both, because they can't agree on increasing the gray, income, taxes, or cutting spending, the part on the left, you get to this gridlock of a fiscal deficit. And what does that translate into? So just like anyone, if I have income and I spend more than my income and I'm short money, I have to borrow or I have to put it on my credit card. But the government doesn't have a credit card. They have treasuries, right? They issue treasuries, and you see a meaningful pickup in treasury sales in the last several quarters. So that's something that we need to worry about, right? And what's likely going to happen is the Republicans, there's going to be conservative members of Congress which are going to start focusing on this, because there are some people, it's going to be focusing that deficit needs to gradually be coming down, and there needs to be some type of a plan. So that's looking a little bit on the budget, and I know I went very quickly, but we could always see if there's questions at the end if I wasn't clear enough. But the point is, there's a fiscal deficit, there's higher emissions of treasuries, And that's something that's going to be affecting yields in the future. So I'm coming to the end. And I've received a lot of questions about the elections, right? We know that Trump, over the weekend, or the recent days, that he not only won the presidency, and not only the Republicans won the Senate, they also won the House. So they now have a mandate where they could potentially instill more changes. I'm going to go a little bit out of order. I'm going to look at what normally happens. Look at the bottom right, the little chart there where it says average S&P 500 return. If you look on an average election year, you see the market, the S&P 500. The S&P 500 is the index, the stock market of the 500 largest companies in the United States, right? So that's the proxy for what the market is doing. Normally, the stock market, or the S&P 500, on a non-election year goes up 11.6%. On an election year, 11%. So it's very similar. Election year, non-election year, okay, it's pretty much on average. But what's different is who wins. If a Republican wins, it's about 15% return. If a Democrat wins, it's about 8%. And that's driven more by policy. And that's, less regulation by the Republicans, lower taxes, and all that benefits companies. So what are the key issues or key stances for Trump? So taxes we kind of touched on. Taxes is something where I'll kind of back up and give you a little history because I mentioned the 2017 tax cuts. The last time Trump won the presidency, he also had control of Congress. And he was able to put something through, some tax cuts that were implemented over a 5-year period, and then they disappear. And they would be disappearing at the end of 2025. Taxes would go back up if nothing happened. So everybody assumed if the Democrats won, taxes would, you didn't have to do anything. This 5-year, break on taxes would disappear. And now there's a lot of speculation that now that he has control of Congress again, that he might extend that for another 5 years. So that's one thing that's likely to happen on taxes. The other thing on taxes is corporate taxes. And this is very relevant. Corporate taxes are 21% under the Trump plan. Under the Democrats, it was 28% and even 32%, depending on what they were looking to implement. Or they were always kind of changing, but at least a minimum of 28. What does that mean? I'm a corporate. I have $7 less in my pocket for my earnings, so that's less money of my free cash flow to put into my business, hire employees, or pay dividends to my shareholders. Trump wins, and all of a sudden that $7 goes to the corporates, so then the stock market kind of starts moving up, right? So that's looking at taxes. Tariffs is something where it's going to be tricky because you can't do tariffs too quickly, otherwise it's going to stall the economy. I won't go through all of them. I'm going to go through one more, which is immigration, because I did get questions on immigration. Remember I told you when we looked at the labor market, there's a gap of 600,000 employees. There's 600,000 more jobs than people looking. So there's a gap. We need 600,000 more workers. How many illegal workers do we have in the U.S. that are working today? 7 million. So if you deport 7 million workers, you're in a big trouble. That gap is a big problem on the labor market. So is it likely that you're going to deport all illegal workers? It's not realistic. So what's more likely to happen is they're going to put security on the borders, kind of block people from coming in, and then they're going to start with those that are more criminal elements in the different communities, and then they're going to go see, and they're going to start there. But they have to be very careful because they don't want to disrupt the labor market when it's very, very tight. Now, if things get back on balance, then they could potentially be more aggressive. But for now, it's going to be very difficult for them to be very aggressive. Actually, I'm going to touch on one more. Energy and regulation, because they go hand in hand. And I think it'll be important for industry, for producers. The policy on energy is to reduce regulation and grow energy, which means lower electricity prices, lower gasoline prices, lower inputs, more margins for the corporates, right? So that's something that's going to be very impactful for business owners. So that's something that is another reason why you have the market moving up. Lower regulation also means more M&A, less anti-competition regulation, and that means more activity, more unlocking value, letting businesses do what they normally do in a normal economy, which the Democrats try to break up a lot of mergers that were trying to happen. So I'm going to finish there. I think I might have gone over my time, but the conclusions: economic conditions remain healthy for now, and they're expected to for next year too, right? The GDP growth for next year expectations are around 2 to 3%, depending on which economist you talk to. We're keeping an eye on headwinds. The finances, we went through it, you know, that little canary in the coal mine, personal consumption, to see if they're going to continue to remain strong. Improving inflation will allow the Federal Reserve to lower interest rates. We saw that, so that's going to be good for the economy. But we have to try to find a solution for the debt and deficits, because that's going to be something that's going to be crucial for 2025. They have to try to find a solution and be more pragmatic. I didn't really talk about the markets, which I'm very happy if people want to, over the cocktail hour, discuss the markets. But in the interest of time, I just focus more on the economy. But expect a lot of volatility, which when we tell our clients, when we work on asset allocation, you focus on fundamental quality, right? Quality companies, quality corporate bonds that kind of work well through the different cycles. So quality, fundamental analysis is very important, especially when you're volatility. And sometimes that volatility gives you opportunities. So happy to discuss that if anybody has any questions, but that's a very important part for us too, asset allocation, and maybe in another time I'll have opportunity to discuss that. So I think that's my time. Noelia, did I do okay? Did I pass? Did I go over? Okay. Well, thank you, everybody. Sincerely grateful for being here.